Hello, and welcome to Let's Chat Mining and Metals, IFRS, or International Financial Reporting Standards. This podcast is the second in a series that explores what is top of mind for mining and metals entities, their CFOs and finance functions, from a business perspective and the flow on financial accounting and reporting considerations. The aim of these podcasts is to highlight topical business issues that may impact your financial and non-financial reporting and broader business. I'm Claire Patra, a senior manager from Ernst & Young Australia. I'm based in Sydney and I'm leading the chat today. And I'm pleased to be joined by Tracy Waring, who is the EY Global Mining and Metals IFRS leader and partner in our financial accounting and advisory services practice. She's based in Melbourne, Australia. Thanks for joining me today, Tracy.
Thanks, Claire. It's good to be here.
And as you can see on the slide, in the first podcast, we discussed the annual survey where EY teams interviewed global mining and metals executives to identify the year's top risks and opportunities. And we focused on the number one risk and opportunity, which was environment and social. And in this session, I'd like to explore another potential area of impact of environmental risks on an entity's financial statements, which is rehabilitation and decommissioning provisions. Tracy, what are you seeing relating to rehabilitation provisions?
Well, as many of you would likely be following or are aware of the relevant media articles on rehabilitation obligations and entities in the industry incurring cost overruns, and certainly the estimate of time needed to retire an asset or rehabilitate it is increasing due to the engineering issues or the additional water treatment costs, for example. I'm also seeing increasing pressure from many regulators around the world around the measurement of rehab and decommissioning provisions. Are they enough? Are they big enough to cover what is going to be required? And also entities are making public statements around climate change and the related impacts on how entities will operate in the future, including certain activities that they may have to undergo to transition to a low carbon economy, which does raise the question, what impact does this have on my accounting?
Thanks, Tracy. So let's explore rehabilitation and decommissioning provisions a bit more and commitments that an entity is publicly making in more detail. So in particular, we're going to touch on two aspects today. So one aspect is the judgment around whether an entity has an obligation to recognize relating to rehabilitation and decommissioning obligations and public commitments. So in the financial statements. And when that obligation arises. And the second aspect is around, once it has been established that there is an obligation, well, how it should measure the value of that obligation. So all around the measurement aspect. So Tracy, dealing with the first judgment around whether an entity has an obligation, as you would expect, public statements and actions require an entity to consider whether provisions and obligations need to be recognized.
That's right, Claire, but it's important to mention that not all public statements made by companies will give rise to an obligation that must then be recognised in the financial statements as a provision. As our listeners would no doubt be aware, it's only those obligations arising from past events that exist independently of an entity's future actions that can be recognised as a provision. That is, there must be an obligating event, effectively akin to a point of no return, i.e. the entity can't change its mind.
So Tracy, what is an obligating event?
So an obligating event arises only where the settlement of the obligation can be enforced by law, or in the case of a constructive obligation, where the event creates valid expectations in other parties that the entity will discharge the obligation or act in a certain way.
Yeah, thanks. I think it's important to note that an obligation to rectify damage already caused may require a provision, whereas an expectation of higher costs of operating in the future, say in an environmentally friendly way, is really a future operating cost and can't be recognized as a provision.
That's right, Claire. You're spot on it. It can't.
Yeah, if we think about the types of commitments and statements that entities and their representatives are publicly making, what are some of the potential financial reporting implications that may arise, Tracy?
Well, as you'd expect, entities are making a whole bunch of public commitments and statements that they are going to behave in a certain way or undertake certain activities in response to climate change. Now, these statements can be made in press releases, in the front half of annual reports, for example, the management commentary section. It could be in a separate climate change or sustainability report. investor briefings, could even be in social media via a tweet. It's important to understand what statements are being made and to assess whether these communications have actually gone to the point that they've created an obligating event that then requires the recognition of a new provision or could impact the way a current provision is already being recognised and measured.
What would your observations be around commitments and statements that are being made and what is recognized and disclosed in the financial statements?
Well, it's really important to ensure that there's consistency between the commitments or statements made and the amount recognised or disclosed in the financials. Or if there is an inconsistency, to understand why they are not the same, remembering that there are specific requirements in the accounting standards that may very well mean that a statement or a disclosure outside the financial statements does not actually create an obligating event for accounting purposes, and therefore for a provision should not be recognised.
And as noted, only those obligations arising from past events that exist independently of an entity's future actions can be recognized as a provision. So if public commitments don't meet the conditions for recognition, then no provision is recognized. However, an entity may have a contingent liability, which is, a possible obligation that only arises if a future event occurs. And let's remember that contingent liabilities are not recognized, but explanatory disclosures are required. Unless, of course, though, the possibility of an outflow in settlement is remote, in which case no disclosures would be required.
So Claire, given what you've just said and given what you've seen, can you give us some examples of what kind of public commitments are unlikely to result in a provision or an obligating event?
Yeah, I definitely can. I mean, a self-imposed ambition or target would be unlikely to result in an obligating event, and even clear targets and milestones would have to be critically assessed. So an announcement that a mine will be closed or reconfigured could give rise to a provision, but the plans would really need to be in sufficient detail, and the employees, suppliers, customers would need to be clear what is being done. And Tracy, I mean, as you pointed out, the actions need to be communicated in a way that leaves no real scope for the entity to effectively, change its mind. So, for example, if the timescale announced for implementation was quite long and therefore could be delayed or extended or otherwise amended, this might not yet be enough to create an obligation that gives rise to a provision. So, judgment is required here. But in other cases, entities will have to challenge their assumptions previously made as a result of expected changes in their business plans. So, for example, provisions may not have previously been recognized for the costs associated with the decommissioning and or rehabilitation of assets such as coal or certain processing plants because they were initially considered to have indefinite useful lives. But these assumptions may no longer hold, and so decisions need to be made about the when, the timing of when to recognize such a provision.
Thanks, Claire. That's really interesting.
And Tracy, moving on to the second aspect of our discussion today. So once an entity has established that there is an obligation to recognize a provision, we come to the measurement side of things. The measurement of a decommissioning and rehabilitation provision will be a result of a number of key estimates, including when will the work have to start, how much work is required to meet the regulatory and environmental standards, how long it will take, how much will the work cost, etc. Tracy, are you seeing many changes to the measurement and estimates of rehabilitation obligations as a result of environment and social considerations?
I absolutely am seeing this. A lot of entities are having to revisit their estimate of their provisions for decommissioning and rehabilitation. For example, they're revisiting whether the timing of incurring the cost will change, for example, being brought forward earlier, or the amount of work required and the associated costs are likely to have changed and possibly increased. Another change that I've seen relating to the measurement of provisions is around the incorporation of risks into the underlying cash flows. This could be changes arising due to changes in technology used to rehabilitate the asset, changes to the mine life if, for example, a mine is going to close earlier, or changes to the interpretation of what a jurisdiction's legislation requires in terms of cleanup activities and costs. Another source of volatility is clearly inflation, especially as the world economy is emerging from COVID and the previous assumptions on low and steady inflation are now being revised.
Tracy, this is clearly a judgmental area, I would say.
Oh, highly judgmental, Claire, absolutely. And there are specific requirements in the accounting standards about what can and cannot be included in a provision. And this can vary depending on whether something is a legal obligation, including whether it's currently legislated, versus a constructive obligation. And obviously, our listeners should remember that even if a new provision is not recognised, there still might be a requirement to disclose a contingent liability, as we mentioned in our first podcast. And an announced change in plans might require the useful life of assets to be reassessed or even an impairment charge to be recognised. So in my view, this is an area where disclosures are critical so that users can understand the key estimates and judgments that have been made in measuring a provision, particularly where there are divergent views of what should and should not be included. At least if you tell your users, they can make up their own mind.
Agree, Tracy. So we discussed whether an entity has an obligation to recognize and when that might occur, and also around the measurement side of things. So Tracy, what would you say is important for our listeners to consider next?
Well, our experience to date has confirmed that now more than ever, the finance function really needs to be connected across the whole business. The right hand and the left hand really need to be speaking to each other. Statements made by people outside of finance can create issues for the finance function, and particularly the question around obligating events. In addition, all forms of reporting, whether that's financial or non-financial, require information to be captured, collated, interpreted, and reported upon, and there needs to be good controls over that information. And all of these skills are core to those who sit in the finance function. So in wrapping up today, some questions I'd like to leave for our listeners to consider would be, how are you ensuring that your climate-related commitments are being considered for financial reporting purposes? How well connected are you across your broader business? And do you know what other parts of the business are doing and saying that could create an impact on your financial statements?
Thanks, Tracy. That's great. And those are some really important questions for people to consider. And so look, as you mentioned, that's all we have time for today. And thanks, Tracy, for joining me. It's been really great.
Thanks, Claire. Great to be here.
So we trust today's discussion has been useful and has given some things for people to think about. We look forward to speaking to you all on the next episode in the Let's Chat Mining and Metals IFRS series.